Okay, so what I want to do now is go backwards and ask the question, now that we understand that systematic risk is important, what does that mean for portfolio theory? Interestingly, the way that the finance theory developed was the reverse. We actually started off by using the CAPM to come up with the cost of capital, and now we're going backwards a bit and saying, given these kinds of ideas of systematic and idiosyncratic risk, what does that tell us about how to construct a good portfolio? So I want to review a little bit about these ideas, and then we'll apply them to the particular context of an orphan disease portfolio. So what is a portfolio and why is it useful? Well, I think we already know from the discussion. It's basically a collection of investments, and these omegas are simply weights that we apply to the various different investments. You can think about them as the dollar amount per investment divided by the total amount of wealth invested. That gives you the kind of weighting that we're talking about. For the most part, the weights that we have in mind sum to 1, so we're not going to be dealing with arbitrage portfolios. The reason we dealt with arbitrage portfolios in that case was very specifically to derive this relationship between risk and reward. But for the most part, what we care about are portfolios that sum to 1, not to 0. Okay? And what we're going to assume is that these portfolio weights summarize most of the information that we care about. There are obviously going to be other aspects of a portfolio that you as a drug developer or an investor might want to include in your deliberations. But for purposes of risk and reward, we're going to just focus on these portfolio weights. And so the example that you've all seen in introductory finance is if you have an account of $100,000 and you allocate it $10,000 to A and 60 to B and 30 to C, your portfolio weights are going to be 10, 60, and 30%. Right? It's just translating the dollar amount into the fractions of your total wealth invested. Here's an example where we're going to be using a little bit more sophisticated set of tools, namely leverage. So the idea here is that in addition to buying stocks, you're also going to be shorting certain kinds of assets. In this case, shorting riskless bonds. What does it mean to short a riskless bond? It means you're going to be issuing bonds, and somebody's going to be buying those bonds and giving you cash. That's an example of borrowing. So this is an important situation because it means that you're taking on more risk. You're actually investing in 200% equities. So if you started off with a certain amount of money, $50,000, yet you're taking a much larger position of $100,000, you are taking on more risk, right? The way you're able to do that is by borrowing money from somebody else in order to take those risks. That's going to be a very important feature for being able to give investors what they want. There are certain investors that really want high risk, other investors that want low risk. Using these tools, we can actually give everyone what they want and be able to maintain a reasonable rate of return for all parties concerned. So the basic idea behind a portfolio is that we want to get away from this notion of picking winners and losers. That's a very difficult concept to get out of the minds of professionals in any given industry. So as an example, if you talk to a venture capitalist in biotech and you tell them, I want you to stop trying to pick the winners, they're going to be deeply offended by that because the whole purpose of biotech VC is exactly to pick the winners. And so what we're talking about from a portfolio theory perspective, in a way, is sort of counter to what good venture capitalists feel is their mission, which is to pick the successes and to get rid of the failures. So that's a very big shift in perspective that I want you to keep in the back of your mind. We're going to bring it to the forefront in a couple of classes, but for now, I think for portfolio theory purposes, it's pretty obvious that what we're trying to do is to create good combinations. And a good combination may not be all the winners. It may be some very strong additions, some in the middle, and a few weaker ones, but where together they provide some useful kinds of properties. Okay? What properties? Well, we know that investors like expected return. Investors do not like risk. So what we're trying to do is to put together a portfolio that has the best risk-reward trade-off. And I think you saw from previous examples that the Sharpe ratio is kind of a good metric. We want to have something that's got a high expected return above and beyond the risk-free rate relative to the amount of risk that you're taking. You want to get paid for taking risk. And so you can think of the Sharpe ratio is your payment per unit risk taken. And so naturally, we want to be paid as much as possible. And that's the key question. How does an asset contribute to that risk-reward trade-off? Is an asset helping you in terms of giving you a better risk-reward trade-off than you otherwise might have without that asset? All right? That's how we're going to use portfolio theory. It's to evaluate the combination of assets and see what have they done for me lately in terms of improving my risk-reward trade-off.